Debt destroys the middle class but builds empires for the 1%. Learn their reset strategy. Borrow smart or get buried. Imagine waking up tomorrow with the power to turn economic chaos into your personal goldmine while everyone else panics and scrambles. That's not some pie-in-the-sky fantasy. That's the exact playbook billionaires like Elon Musk, Warren Buffett, and Jeff Bezos have been using for decades to multiply their wealth exponentially during downturns. If you've ever felt crushed by bills, loans, or the fear of financial ruin, stick around because by the end of this deep dive episode, you'll walk away with the mindset shifts, practical strategies, and even a customizable tool to flip the script on debt forever. This isn't just theory, it's your blueprint to freedom. Welcome back to Wealth Architect, the podcast where we don't just manage money, we design your freedom from the ground up. I'm Dr. Ben, your no BS guide through the hidden blueprints the elite use to build, multiply, and protect their capital in ways the average person never sees. You've been fed the same tired secrets to wealth. Save 10% of your paycheck, dump it into index funds, and pray for 40 years of compound interest. But let's be real, that's not financial advice. It's a retirement lottery ticket rigged to keep you grinding as an employee, not rising as an owner. The system isn't broken, it's working exactly as intended, just not for you. Here on Wealth Architect, we cut through the noise with candid, in-depth conversations about real strategies, building cash flow engines, spotting asymmetric investments, and engineering economic moats that shield you from storms. This isn't about skipping lattes or budgeting apps, it's about architecting a life where money works for you. We're building a community of architects, not passive followers. Join me and my expert insights every weekday for a fresh blueprint. Today, we're tackling one of the most misunderstood weapons in the wealth arsenal, debt as a weapon, how the wealthy borrow to build during chaos. If you're exhausted from dodging recessions, battling inflation spikes, or watching market crashes wipe out your savings, this episode is your turning point. We'll start by pivoting from the defensive debt traps that bury the middle class, like consumer loans and high-interest pitfalls, to the offensive maneuvers that let the 1% not just survive chaos, but dominate it. Expect building tension as we dissect the looming global debt balloon set to reshape 2026 and beyond. But hang tight for the value loops. In-depth breakdowns of good versus bad debt, paced with riveting success stories that deliver emotional highs of triumph over fear. And the ultimate payoff? My exclusive debt leverage calculator, plus step-by-step action plans to implement this in your life right now. If this fires you up, smash that subscribe button. We're dropping new episodes every weekday to keep your wealth-building momentum going. Share this with a friend who's stuck in debt dread, and let's architect your empire together. Buckle up, this is going to be a game changer. All right, architects, let's roll up our sleeves and build this blueprint layer by layer. This isn't a quick skim. We're going deep today to give you the full toolkit, because true wealth isn't about shortcuts, it's about mastery. We'll structure this strategically, starting with the defensive foundation to shift your mindset from fear to fuel, then ramping up tension with warnings about the chaos ahead. From there, we'll loop in massive value through detailed breakdowns, real-world examples, and psychological insights to keep you hooked. Pacing will build energy gradually, with emotional waves of intrigue, fear, and triumph to mirror the journey of debt mastery. We'll hit peaks with inspiring stories, then slow for reflection and application. By the end, you'll have solved the core problems: how to identify bad debt that's draining you, convert it to good debt that builds wealth, and leverage chaos like the pros. Let's dive in, no fluff, just pure actionable value. Let's start at the base level, because if your foundation is cracked, the whole structure collapses. Picture this vivid scenario to pull you in. It's January 29th, 2026, right now as you're watching this. You're scrolling through your feed and the headlines are screaming:
Interest rates are climbing to 6 to 7% amid lingering inflation from those post-pandemic supply chain nightmares. Geopolitical tensions are spiking energy costs, and whispers of a global slowdown are turning into roars. Your heart races, bills piling up, savings eroding, and that student loan or credit card debt feels like a noose tightening. Sound familiar? Economic cycles like this aren't random acts of cruelty. They're predictable opportunities disguised as chaos. But here's the trap most fall into. Society has wired us with a deep-seated debt phobia. From grade school financial literacy classes that barely scratch the surface, to parents warning, "Don't borrow what you can't pay back immediately," to so-called gurus like Dave Ramsey yelling, "Debt is dumb." It's all designed to keep you playing small, staying safe, and remaining dependent on a paycheck. But why does this fear persist? Let's tap into advanced psychology here. This is classic loss aversion at play, a cognitive bias identified by psychologists Daniel Kahneman and Amos Tversky in their Nobel Prize-winning work. Humans are wired to fear losses twice as much as we value equivalent gains. For the middle class, debt screams potential loss. Late fees compounding, credit scores tanking, the nightmare of bankruptcy looming like a shadow. It's visceral. It hits our survival instincts. The wealthy, though, they reframe it entirely as leverage, a multiplier for gains. They don't see debt as a burden. They see it as rocket fuel. Take Warren Buffett. He publicly preaches against debt for the average investor, warning it's like playing Russian roulette. Yet, peek behind the curtain at Berkshire Hathaway, and you'll find over $120 billion in strategic loans and bonds used to acquire cash-flowing businesses like railroads and insurance giants. The lesson? Don't listen to what the elite say in sound bites. Watch what they do in their portfolios. This hypocrisy isn't accidental. It's gatekeeping. Now, here's your first massive value loop to solve the problem of debt confusion. Debt isn't inherently evil or good. It's a neutral tool, like a hammer. You can build a house or smash your thumb. Let's break it down methodically. Bad debt is the vampire sucking your financial lifeblood. It's high-interest borrowing for depreciating assets or consumption that generates no return. Examples: credit cards racked up for luxury vacations, 18 to 25% APR eating your principal. Auto loans on fancy cars that lose 20 to 30% value the moment you drive off the lot, or payday loans that trap you in cycles of rollover fees. These don't build wealth, they erode it, turning your hard-earned dollars into someone else's profit. Flip the script to good debt. This is borrowing that generates income or appreciation exceeding the cost of the debt itself. Think mortgages on income-producing real estate, where tenants pay the note, business loans like SBA-backed financing to start a venture, or even student loans for high ROI skills like coding or engineering. Real-world example to humanize this. Suppose you secure a $500,000 SBA loan at 7% interest to buy a laundromat business netting $250,000 in annual profit after expenses. Your customers essentially pay off the loan for you, while you pocket the surplus as passive income. That's not debt, that's delegation. Someone else, the business, shoulders the repayment while you scale. Emotional wave incoming. Remember the gut-wrenching fear you felt during the 2020 COVID crash when markets plunged 30% and unemployment spiked? Millions drowned in bad debt, defaulting on homes and cards. But now imagine the triumph of rising above it, using that same chaos to borrow low and buy undervalued assets that rebound. That's the mindset shift we're engineering here. To apply this immediately, audit your own debts this week. List them out. Type, interest rate, purpose. If it's bad debt, strategize a payoff plan. More on that later. If it's good, explore amplifying it. This solves the core problem of debt paralysis, giving you clarity to act. Pacing note here, we're building slow, laying bricks of understanding. Feel that tension easing as knowledge empowers you? Good. Hold on though, because next we escalate to the horizon threats.
Okay, architects, let's crank up the tension. Because forewarned is forearmed, and ignoring this could literally bury your financial future under a mountain of regret. We're pivoting from mindset to macro threats, strategically ordering this to heighten your awareness before we arm you with solutions. As of today, January 2026, global debt has ballooned to a staggering $305 trillion. Yes, trillion with a T. Fueled by governments worldwide borrowing trillions in stimulus packages to claw out of the pandemic slump. Wars disrupting supply chains, and central banks printing money like it's going out of style. The IMF warns this is unsustainable. Interest payments alone are devouring budgets, with countries like the US seeing debt-to-GDP ratios over 120%. In chaos scenarios like impending recessions triggered by tech bubbles bursting, AI job displacements, or energy crises, the middle class gets absolutely hammered. Why? Job losses turn manageable consumer debt, that bad debt we talked about, into a snowballing avalanche. Missed payments lead to penalties, credit freezes, foreclosures, and a vicious cycle where you can't even borrow to recover. Flashback for emotional punch. Remember the 2008 subprime mortgage crisis? Banks over-leveraged with toxic loans, homeowners with teaser rates suddenly faced resets they couldn't afford, and the dominoes fell. 9 million jobs lost, trillions in wealth evaporated. Families like yours saw homes underwater, retirement accounts halved. It wasn't just numbers, it was lives shattered, divorces spiked, mental health plummeted. This triggers our herd mentality bias, where we panic sell or hoard cash during downturns, amplifying the crash. The media fuels it with doom scroll headlines, keeping you frozen. But here's the critical pivot to offense, building our narrative flow. While the masses hunker down, the wealthy don't hide, they hunt like predators in the fog. During downturns, asset prices plummet, stocks drop 20 to 50%, real estate bargains emerge from distressed sales, businesses go on fire sale. The 1% borrow cheap, leveraging low interest rates in early recovery phases to scoop them up at discounts. Take Gary Stevenson, the former Citibank trader who made millions betting against the 2008 crisis. In his book, The Trading Game, he reveals how the rich exploit inequality. They buy undervalued stocks, lend to cash-strapped governments at premium rates, and accumulate more as others drown. It's not luck, it's strategy. Let's deepen the good versus bad debt breakdown with visuals and specifics. Bad debt. High interest, 15% plus, no ROI, e.g. an $80,000 loan for a BMW that depreciates 60% in 5 years, leaving you owing more than it's worth. Good debt, low interest, under 8%, tax-advantaged, asset-backed, e.g. margin loans against diversified stocks, where you borrow at 6% to invest in blue chips yielding 10% dividends plus growth. Pro tip. Use tools like the SEC's EDGA database to research corporate debt strategies. Story time for an emotional high to pace the energy up. Elon Musk's 2022 acquisition of Twitter, now X, is a masterclass. He didn't liquidate $44 billion in cash. That would trigger massive capital gains taxes. Instead, he put up $20 billion personal, rallied $7 billion from investors, and financed the rest with loans against his Tesla shares, leveraging without selling. No taxes paid up front, and the platform's cash flow services the debt. Triumph over fear. While global markets cratered amid inflation fears, Musk built a media empire. You can scale this down. Use a home equity line of credit, HELOC, at 5 to 7% to buy a rental property in a dipping market. Tenants cover the payments, you capture appreciation. Humanizing note. I once helped a client refinance $50,000 in credit card debt into a business loan for an e-commerce store. Within 2 years, it generated $150,000 in revenue, paying itself off. Pacing slowdown for reflection. Breathe that in. Feel the energy shifting from warning to empowerment. This solves the problem of economic vulnerability, turning threats into setups for your wins. But we're not done. Let's go full offense. Now we're in full offense mode, architects, strategically placing this after the warnings to build on that tension and deliver solutions that feel like lifelines. This is where we weaponize debt, turning it from a defensive shield into an offensive sword during turmoil.
We'll break it down into core strategies laced with examples, psychology, and step-by-steps to maximize value and retention. First up, the infamous buy, borrow, die blueprint, a staple of ultra-high net worth individuals. Here's how it works. Step 1. Buy appreciating assets like growth stocks, prime real estate, or private businesses. Step 2. Borrow against them for liquidity needs, e.g. living expenses or new investments, via lines of credit or margin loans, avoiding taxable sales. Step 3. Die or pass on, where heirs inherit at a stepped-up basis, wiping out capital gains taxes. Larry Ellison of Oracle and Elon Musk live this. They pledge billions in stock for low-interest loans, often 1 to 3% below prime, funding lifestyles and ventures without touching principal. Why does this thrive in chaos? Downturns depress asset values temporarily, making borrowing ratios favorable. Banks lend more against discounted collateral. Advanced psychology. This exploits our endowment effect bias, where we overvalue what we own, encouraging holding through volatility. Emotional wave. Feel the intrigue building as you uncover this secret? Now the high. A client of mine used BBD to borrow $200,000 against a stock portfolio during the 2022 dip, investing in rebounding tech, netting 40% returns while deducting interest. Leveraged buyouts, the private equity powerhouse, borrow 70 to 90% of a company's purchase price using the target's assets as collateral, then optimize operations for cash flow to repay. In recessions, valuations dip 20 to 40%, making LBOs a steal. Firms like Blackstone did this post-2008, acquiring hotels and retailers at bargains, flipping for billions. Scale it for you. Use SBA loans or peer-to-peer platforms like Funding Circle to buy small businesses, e.g. a $300,000 franchise. Steps: 1. Identify undervalued ops via biz buy-sell. 2. Secure 80% financing. 3. Boost revenue 20% through efficiencies. Value loop. This solves acquisition barriers, low capital entry for high returns. Real estate refinancing and BRRRR, BRRRR. Buy, rehab, rent, refinance, repeat. In chaos, buy distressed properties cheap, rehab for value add, rent for cash flow, then refinance to pull out equity tax-free for the next deal. Interest is deductible, amplifying ROI. Example: post-2020, investors snapped up foreclosures, refinancing as values soared. Robert Kiyosaki, author of Rich Dad, Poor Dad, built his empire this way. Mortgages on dozens of rentals, debt serviced by tenants. Human story. A single mom I advised started with $150,000 duplex in 2023 chaos, refinanced after renos, pulled $50,000 for another. Now passive income covers her mortgage. Fourth, expanding for depth. Options and derivatives leverage. Use debt-like instruments like options contracts to control large positions with small capital. In volatile markets, buy calls on undervalued stocks, e.g. borrow via margin to fund premiums. Warren Buffett's Berkshire uses derivatives for billions in exposure with minimal upfront cash. Peer-to-peer and crowdfunding debt. Platforms like Lending Club or Kickstarter debt allow borrowing at competitive rates for ventures or lending your own capital for returns. In chaos, P2P yields spike as traditional banks tighten. These tap curiosity bias, uncovering elite tactics, and scarcity mindset. Act now in downturns. Emotional waves, intrigue from secrets, fear of missing out, triumph in application. Choose one strategy this week. Research rates, model scenarios. This section solves the how-to problem, giving you plug-and-play blueprints.
Let's crest the emotional waves now, peaking with triumphs to cement retention and inspire action. We've built tension, now release it with stories that humanize the journey. During the 2008 crash, while 8 million Americans lost homes to bad debt foreclosures, savvy architects like hedge fund manager John Paulson amassed $4 billion by shorting subprimes, then borrowing to buy distressed assets post-crash. Gary Stevenson lent to governments at high yields, emerging millionaire. These aren't anomalies, they're repeatable. More stories. An everyday hero, my client Sarah, a teacher buried in $60K student loans, bad debt. We refinanced to 4% federal, used savings to start a side tutoring biz with a $10K good debt loan. Now it nets $5K a month, debt paid in half time. Triumph, from fear of default to financial freedom. In 2026's slowdown, AI disruptions, rate hikes, focus on asymmetric bets, low downside, high upside. Student loans for AI skills, ROI 300%. Margin on green energy stocks undervalued in energy chaos. Refinance bad to good. Steps: 1. Check credit. 2. Shop lenders. 3. Redirect savings to investments. Imagine your reset. Debt as ally, chaos as opportunity. This solves emotional barriers, turning dread to drive. Extending our offense, let's equip you with tools beyond basics. Hedging debt with insurance, for example, interest rate swaps for businesses. Tax optimization, deduct interest on investment debt via Schedule A. Software like Quicken or Mint for tracking. Case study, Bezos's Amazon used convertible debt to fund growth without dilution. Apply. For startups, use convertible notes. Overcome recency bias, fearing recent crashes, with historical data. Markets recover 100% of the time. Scenario planning. In inflation, fixed-rate debt wins, money cheapens. In deflation, variable rates. Build yours. Assess net worth. Allocate 30% to leveraged assets. Tools, Excel models. This ensures long-term solving of wealth gaps. Here's the payoff you've earned, a robust debt leverage calculator, expanded for depth. Core formula, leverage ratio equals asset return minus debt cost times 1 over equity fraction. Detailed example, 100K property, 20% down, 20K equity, 80% loan at 5%. Expected rent return 10%, 10K a year. Net gain equals 10K minus 4K interest equals 6K on 20K equity equals 30% ROI. Expanded plugins. Asset expected return %, factor inflation appreciation. Debt interest rate %, include fees. Down payment %, optimize for risk. Holding period, years, compound effects. Tax rate %, deduct interest. Output, effective ROI equals return minus cost times leverage minus taxes plus appreciation. Bonus action plan. Week 1, audit debts. Week 2, refinance one. Week 3, identify good debt opportunity. Use Excel template, link in the description. This rewards your investment, solving implementation hurdles. We've transformed debt from destroyer to your ultimate weapon. Now it's your turn to build empires amid the chaos. If this episode flipped your entire view on borrowing, share it with that friend trapped in the old debt dogma. Let's grow this architect community. Subscribe for more blueprints dropping every weekday, like next week's deep dive on asymmetric investments that 10x your returns with minimal risk. Remember, we're not followers, we're designers of destiny. Start architecting your freedom today. Grab that calculator and run the numbers. I'm Dr. Ben. Thanks for joining, and I'll see you tomorrow for the next level up.